So finding ways to pay less in taxes is literally the catalyst that promotes wealth generation. One tax strategy that is extremely common in real estate is called the 1031 exchange, or the 1031 tax deferment. So in this video, we're going to break down exactly what it is, some of the rules you have to follow, and how you can use this for your investments in the future. So let's get to it. So anytime you hold an asset, a property, maybe a piece of gold or jewelry, and you buy it for a certain price, if you were to sell it for more than what you bought it for, that's considered a capital gain. Now, if you were to buy it and then sell it in less than 12 months, they're going to consider that a short capital gain. And if you bought it and held it longer than 12 months before you sold it, then they're going to consider that to be a long-term capital gain. Now, what the 1031 does, it allows you to not pay taxes on it immediately upon the sale. Instead, they say, yeah, you can pay taxes, but we'll just push it down a few more years, maybe 10 or 15, or hell, we'll just keep kicking that ball along until your time is up. So to paint a picture here, let's say that you bought a property for $1 million, and now several years have passed by and you decide to sell it for $5 million. Well, see, the difference there is $4 million, meaning you would have to pay capital gains tax on $4 million. Now, long-term capital gains can go up as high as 28%, meaning that if you had $4 million in capital gains, then you'd be paying over $1 million in taxes. So we want to make sure that we protect that, and a 1031 is going to defer that, meaning, hey, we sold it here and this year, today, but we don't have to pay taxes today because we're going to use it for another purchase. So we'll just pay taxes at the end of all these subsequent purchases that we're going to do. So how does it actually work? Well, it starts by finding a qualified intermediary, or QI for short. Now, a qualified intermediary is basically just an entity that is approved to hold your money from the IRS and make that exchange on your behalf. They can track all the paperwork just to make sure that everything is done by the book. So with that being said, when you're searching for different qualified intermediaries, you want to make sure that you're not just going to the cheapest route. You want to make sure they have a good reputation, they know what they're doing, and they can actually help you achieve your goals. Now, once you find the qualified intermediary, you'll get an understanding of the entire process before you ever go to sell your property, which is extremely important because although you can sell your property and then try to go back and do a 1031, it's not recommended, but we'll touch on that a little bit later. Now, the ground rules are that you have to actually exchange it for like kind. Now, by like kind, what we mean is real estate to real estate. One common question is, hey, I have an apartment building, but I'm looking to sell this and I want to buy a warehouse, or I want to buy a mobile home park, or I want to buy a retail strip. Can I actually do that? And the answer is yes, you can, because you're moving from investment real estate to investment real estate. The second rule is, in order to actually protect the funds, you have to put in equal amount or more money than what is actually sitting in that 1031 exchange fund. So going back to our previous example, if we had $4 million left that we needed to protect, and we wanted to actually protect all 4 million, then that entire 4 million will have to go into the next purchase or the next property that we're doing. And rule number 3 is that you have to buy an equal or larger valued property. Meaning if we sold our property for 5 million, the next purchase will have to be at least 5 million or more. Now that you know the rules, the QI is going to outline the timeline requirements. So there's 2 major timeline requirements, and the timeline starts at the date of sale of your property. So the first timeline is that you have to identify the property or properties that you actually want to exchange with within 45 days. And the second timeline is within 180 days, you actually have to fully complete that purchase or that transaction. And remember, both of these start on the day of sale of your property. So now let's talk about that 45-day window to identify your next property. There's actually 3 different options that you can go by. The first option is the 3 property rule. Essentially, this says that you can go out and identify any 3 properties that you want, but it's only 3 properties. This is typically the most common option because we understand that we have to put in equal or greater amount, and typically we're going to upgrade. We're not going to buy an asset that's of same value. We're typically going to take that money and to put it into something of more value. So this is one of the most commonly understood methods when it comes to identifying the next property. Now, the second option is called the 200% rule. And instead of just dumping all of your money into one property, this option is often used when you want to dump it amongst several different properties. So with this example here, instead of only identifying 3, they say you can identify as many properties as you would like, but they cannot exceed over 200% of your sales value. So in our example there, if we sold it for $5 million, then all of the properties we identify can't exceed the amount of $10 million in value. And option 3 is a little bit more complex, but it's called the 95% closing rule. Now this one, you're basically combining option 1 and option 2. You can pick as many properties as you want with no pricing limit. However, the caveat is that you must close on at least 95% of the identified properties. And because we all know real estate and things can happen, this type of strategy is typically reserved for those that are buying all cash, or maybe they're really sophisticated investors. After you choose your option and then you identify whatever properties that you choose in the next 45 days, the 180 days is pretty straightforward. You just have to go to the closing table. Now, if this is good stuff, guys, you want to continue to support Mike, now's the time to hit the like. As always, I appreciate you, but let's get back into it. All right, so now that you've gotten everything picked out and you're ready to close, you go to the closing table. What actually happens behind the scenes? So now when you sell the property, what's going to happen is essentially a double close. Now this is all happening simultaneously, so it's not quite a double close, but this is the easiest thing to refer to so you can get a good image in your mind. So what happens is you go off and you sell your property, and when you sell it, the new owner is actually the qualified intermediary. So the QI is the new title holder, and then they sell it to the new buyer. So now that the buyer owns it, all the funds that the buyer gave is sitting now with the QI. Now that qualified intermediary is going to hold that money until you're ready to actually purchase the next property, because see, that is how it gets protected, and that's how you don't pay any taxes on it. So let's say that you actually went to that QI and you pulled some of the money out, or you touched any of that money whatsoever. Well, that now becomes a taxable event, and you could say goodbye to your deferment. And then when you buy your new property, as long as it fits within those 3 rules, that it's a like kind investment, real estate to real estate, that you put in equal or more funds than what's actually sitting in that 1031 pile, and that the property is equal or greater value than the property that you sold, then you officially deferred paying taxes on that until you go and sell the next property. Now, typically what you'll see by sophisticated investors is they're going to continue to defer paying taxes by doing 1031 exchanges over and over again for 20 or 30 years before they do something tricky but completely legal to pass it on to their heirs and not pay any taxes at all. If you guys are interested in that, let me know and we can make a video all about that. But first, let's talk about that other option with 1031. A lot of times I'll get questions like, hey, can I go ahead and just buy the property now and then sell my property and try to 1031 the funds later? And the short answer is yes. However, that's a lot more complicated. That's called a reverse 1031. And to be quite honest, you're going to need to go to your qualified intermediary and get the full scoop of how that's actually going to work with you. There's a lot more risk in that as well, where it's not necessarily guaranteed that all of the money that you're going to use is going to be tax deferred, which is why we like to be proactive and maybe doing a 1031 exchange from the beginning, or at least researching it and talking to that QI from the beginning is going to be much more beneficial in the long run. And we're just scratching the surface, guys. So if you are interested in more real estate investment tips, then go ahead and follow me, subscribe, and leave some comments below about other topics that you're interested in as well. I'll see you guys in the next video.